and thank you for watching Dukascopy TV. Today I am joined down the line by Geoff Kendrick from Nomura for this week's final edition of Targets in Focus with a bit of a Euro theme. So Geoff, to start us off, economic morale in the Eurozone improved for the first time in almost a year in November, but is there any danger that industry's reluctance to invest next year bodes poorly for a quick recovery from recession?
Absolutely. I mean, what has changed in the last few months, specifically since the ECB meeting in September, is that the tail risks in Europe have been reduced, and as a result we've seen flows in and out of the Eurozone and even within the Eurozone start to normalise. But unfortunately what hasn't changed is that the Eurozone as a whole is in recession, and it's much more probable that every quarter next year will be negative growth for the Eurozone as a whole. So unfortunately we're now moving from a very strong tail risk scenario, which had been around Greece, Spain, etc. this year, into one next year where it's more about growth being very soft throughout the calendar year.
If we take euro-dollar, according to some, this pair will find it difficult to sustain any moves above the 1.30 and will struggle next week amid ongoing fiscal cliff uncertainty and probably negative ECB revisions to the growth outlook. Do you agree with this? And what is your short, mid and long-term outlook for this pair?
So our view is consistent with that, in that we're getting quite close to a selling opportunity. We had been waiting for Spain to ask for assistance. Perhaps we're now waiting until we get past the Fed meeting the week after next, just in case there's some more QE coming from the Fed. A lot of analysts are talking about another $45 billion in long-term Treasury buying after twist rolls off. So after we get through those specific risks, really everything points to the downside for euro-dollar, and we're expecting it to go to 115 by the end of next year. Again, that's mostly on the relative growth story, assuming we get through fiscal cliff. US growth of 2% plus looks pretty good these days when we're comparing that against Eurozone of negative growth every quarter. And even if we did have fiscal cliff concerns continue, as you've already mentioned, it's more likely that would be risk off, and so equities lower, and that would probably be euro-dollar lower. So it's almost like either way next year, either we go into a relative growth story, which is dollar positive, or we get fiscal cliffs continue, and that becomes risk off, which is also dollar positive, as being the most likely direction.
Following a successful run on stops beyond 105.4, the euro managed to change its fortune against the yen. Whilst there might not be any indicators of a yen panic buying at the moment, do you believe that the closer we get to the Japanese December 16th election, the more likely a big yen buyout becomes? And what do you think 2013 has in store for this pair?
So our view for euro-yen is really split into the two halves. So I already outlined the euro-dollar downside view. Because euro-dollar is normally marginally more volatile than dollar-yen, that means that we've also got a euro-yen downside view next year, albeit very marginally. So we're expecting a move next year down to around 101. But on dollar-yen itself, which is really the most interesting part, particularly for Nomura at the moment, we're expecting a move up to 88 next year, and that's on the back of expectations that the BOJ become more aggressive after Shirakawa rolls off in April. The trade situation continuing to be in deficit, which is going to create further yen selling, and potentially after we get past the fiscal cliff in the US yields pushing higher. So it's really a case of the dollar outperforming both against euro and yen, but because euro-dollar tends to be more volatile, euro-yen in a very gradual grind to the downside.
Euro-pound traded lower yesterday in the wake of disappointing UK data. The pair has been described as trading flat in spite of it being a macro-heavy week in both Europe and the UK. With the great deal now reached and UK markets optimistic on Mark Carney's appointment to the BOE, what are your expectations for this pair moving forward?
So I'm relatively upbeat on sterling. I think the fact that UK growth remains very close to zero outside of the Q3 jump that we had more recently in terms of GDP growth. Really the big story here is inflows, and we did have data within the UK debt numbers that showed that in the month of October, when we price adjust, there was another 6 billion inflows to buy gilts. That comes on the back of Q3 data where we estimate about 17 billion in total. In terms of that 17 billion though, about 2/3 came from direct S&B buying as they diversified out of the euros they previously bought for intervention. So we had been concerned that now that the S&B is likely to have stepped aside because Euro Swiss is not trading near the floor, there would be few buyers, but the data suggests that was that is not the case. And so as a result, We're expecting gilt inflows to continue. AAA status of the UK is the main story here, not the fact that growth is close to zero or perhaps even negative in some more quarters to come. And as a result, we're expecting euro sterling to grind lower through the year next year, down to around 75 by the end of the year.
Geoff, thank you very much for your insights today. It's been great speaking to you. Well, that brings Targets in Focus for this week to an end, but please do stick with us for the weekly wrap-up with my colleague Rowena Harris-Doughty. Bye for now.